So if you're like me, you enjoy a good round of golf now and again, and I wanted to share today a little bit of a history lesson about the intersection of golf and finance that not too many people know about. So several decades ago, back in Augusta, Georgia, there was a conundrum. You see, the Masters were played there every year, and the big TV network crews would come in, and they'd need a place to stay, right? So they would approach the homeowners who lived on the edges of the golf course and in the area, and offer them these obscene amounts of money to rent their house, but just for 2 weeks or so. And in order to do so, the homeowners were delighted to receive the money, but what happened is at the end of the year, as they were getting ready to do their taxes, they began to realize that, hey, this is gonna suck in paying the IRS. So what ended up happening is they came to the IRS and they said, look, this is our conundrum. What can you guys do for us? And they must have had some connections or something, because what ended up happening was the IRS came out with what's known as the Augusta rule. That is, section IRS 280A of the Internal Revenue Code tells us that as long as it is for 14 calendar days or less, you are allowed now to rent your house, and it can be tax-free income. So where does this apply to, say, you and me? Well, if you're a business owner, what this means is that your business can rent your house from you legitimately for 14 days or less out of the calendar year, and not only is it a deduction to the business, but it's also tax-free income, thanks to the Augusta rule, in your own pocket. It's like taking money from your business pocket and putting it into your personal pocket, and it's free of taxes, plus you get the deduction. So there are a few key things that I want to make sure that if you do decide to explore this rule, you use it correctly. There was a tax case that came down recently where there were a group of doctors, and they ended up using it as simply a tax shelter, and they got slapped pretty hard on the wrist by the IRS. So it is imperative that if you do decide to use this rule, you do so in the correct manner, and that you also consult a good tax advisor. So if you have a good CPA accountant on your side who knows about this, fantastic. If not, I'd be happy to introduce you one. We're not tax accountants ourselves, but we are happy to make that introduction, and it's something that we've helped our clients with before as well. So 3 key things that you need to know if you're considering using the Augusta rule in your business. First and foremost, it needs to be a legitimate business purpose, not entertainment. So an easy example of this would be a monthly board type meeting. Let's say you're a small LLC, you've got a couple of members, maybe it's yourself and your spouse. Once a month you meet. That's a legitimate business purpose as long as you're discussing business needs, etc. Which brings us to number 2, keeping records. You want to make sure that you keep minutes of whatever meetings you have. This is imperative, because if the IRS ever comes knocking, you're going to want to be able to submit this to them and say, look, we were actually having these meetings for business purposes. And along with that, when you do invoice your business, you want a paper trail. Pay that invoice from the business account. Make sure that that invoice is kept record of, so that again, if the IRS comes knocking, you're ready. And then finally, number 3, make sure that you're charging a reasonable rate. Take a look around at the market around you. What would a similar hospitality venue charge? And make sure you include things like, refreshments, meals, drinks, etc. if that's going to be served during your meetings. And then come up with what would be a reasonable rate. And if you're wondering, does this seem like it's a good idea, or is this too high, too low? Again, run it by your advisors. So again, 1, it has to be a legitimate business purpose. It can't be just entertainment. 2, you want to make sure that you're keeping a paper trail, minutes, invoices, etc. The more the better, right? And then finally, 3, make sure that you're charging a reasonable rate. You can't charge 3-4 times the market and then expect to be able to sit before the IRS with a straight face and defend that. So if this is something that you're considering, here's a quick example that might be how it would look for you, or perhaps someone who you know. Let's say again, you're a small LLC, you've got yourself, maybe your spouse who's also a member, and you set up a regular monthly business meeting where on the first Monday of the month you're sitting down at your house, it has to be at your house obviously, and talking about business related topics. You keep minutes of the meeting, you invoice it, you pay that check from your business account, those records are kept somewhere where they can be accessed, perhaps you even proactively submit the minutes to the IRS. And then finally, the rate that you charge is also reasonable because you've done the research, maybe even talked to a realtor connection of yours and had them do an analysis for you. That's how it would look in theory. So if you want to put that into practice or you have further questions, if this is of interest to you, drop a subscription and a like, give us a quick DM or say a call on the phone. We're happy to talk that way too. But we can walk through what this might look like in your situation. And in the meantime, I'll see you out there.